Hoje um grande prazer ter a Juliana Salomão, ex-aluna da casa, que vai apresentar seu trabalho sobre Peru. Juliana, the floor is yours.
Thank you so much. Eu vou mudar para inglês a apresentação, porque se eu falar em português, eu vou parecer uma criança falando economia. Tem muito tempo que eu não falo português em economia, então eu peço desculpas. Eu juro que eu tentei, mas eu vi que não ia dar muito certo. Eu estou muito feliz de estar aqui na PUC, falando com vocês. Tem 13 anos que eu me formei no mestrado, e a PUC é minha casa. Eu sou filha da PUC desde que eu comecei. Eu fui PET, e então o Werneck é meu início de pesquisa, e o Márcio Garcia foi meu orientador durante todo esse tempo, então fico muito feliz de estar aqui. Então, vou falar um pouquinho com vocês sobre esse artigo que eu venho trabalhando com a Vitória Vachina, da HBS, e com o Brian Gutierrez, e é muito em linha com uma pesquisa que eu venho desenvolvendo, que é entender um pouco essa coisa de finanças corporativas com diferentes moedas, né? Então, so in this paper, we have a very traditional question, which is that we seek to understand why, especially in emerging markets, is dollar credit so predominant? And what makes this question puzzling is that regardless of the fact that it's well known that dollar credit can be connected with economic crisis and that regulators try to impose policies to discourage it, we still see a large volume of credit being voiced in dollars in these markets. So when we think about credit, we're thinking about loans. So this is going to be focused on bank loans that firms take in different currencies in Peru. In this paper, we're going to use this novel data set for Peru that has never been used for academic research before. Peru is a heavily dollarized emerging economy. And we're going to use this novel data set to understand the forces behind corporate credit dollarization. Our data set is going to allow us to measure the size of the dollar discount in these loans and also trace the sources by looking closely at banks' balance sheet and banking regulation. So let me tell you a little bit about our main findings. So first, we find that in line with survey and anecdotal evidence, that firms borrow in dollars because dollar is cheaper. Using this data set where we actually observe interest rate on loans, and this is a rarity. It's really unusual to be observing what is the interest rate on loans. We usually only see like credit registry type of data. So because we observe the interest rate in loans, we're able to quantify how much cheaper is dollars, and the answer is 2%. So just to put this number in perspective, the annual interest rate in soles, which is the local currency, between 2012 and 2018 for these loans is on average 7%. And for loans in dollars is 5%. So this is this 7 minus 5 is this 2% that we're talking about. What I'm going to show you is that this result is very robust to an array of loan and firm level controls and very stable over time. Second, our second contribution is that we're going to be able to provide evidence by exploring policy changes to the explanation that ties dollar borrowing and dollar discount to the local preference for dollar savings. Dollar deposits are strongly preferred and compose 60 to 70% of bank dollar liabilities. These depositors are inelastic and are willing to take these big discounts in the deposit rates to keep dollar savings. The fact that dollar financing for these banks are so cheaply priced, together with bank regulation, is going to lead these banks to pass through the discount to the borrowers. And this is going to be at the core of the cheapness of the dollar loan and its dominance, the fact that it's cheaper. Let me help you place a little bit of our findings in the literature. So we relate to several strands of the literature. I'm going to highlight a few papers. This is a very massive literature. So first literature that we relate to is this carry trade, corporate carry trade literature that I myself have contributed to. And it's that we expand this literature that talks about the fact that corporate carry trade or that firms borrow in dollar because it's cheaper, we're actually able to quantify how much cheaper, which is something that before hasn't been possible because the data doesn't exist. And using our loan level interest rate, which is extremely rare in the literature, we actually quantify by how much cheaper. This is our 2% contribution, the 2% number coming from. The other literature is that some of these discounts can be traced back to dollar convenience yield. However, direct measures of this convenience yield usually arrive at smaller numbers. here I show you two papers that think about this convenience yield, this idea that, dollar is cheaper because there's a lot of demand for dollar assets. These two papers kind of use a structural estimation, and they get closer to this 2% number that I see, that we see in the data. But the difference is that Moto's paper and Krishnamurti, Lustig, and Zhang's, these papers kind of use government financing. And what we see is that actually for emerging markets like Peru, what the forces that are behind these is local preference for dollar, right? So it's not a market-driven thing, but it's more of a local depositor preference for dollar. We also connect to this bank balance sheet literatures that highlight the importance of global banks and financial cycles. What we do see is that we do not see like this stronger role for international capital flows or global banks. In our data, local and foreign banks have similar shares of dollar deposits and dollar deposit rates. So there's no heterogeneity over different types of banks. Furthermore, our interest rate data allows us to explain bank behavior and connect the dollar discount to the dollar deposit differential. Finally, we're going to find empirical support for the theory that is proposed by Boccola, Lorenzoni in AR, and also Gita Gopinhard and Jeremy Stein, that kind of traces back this desire of insurance from depositors or even from firms that are exporters into holding these foreign currency assets. And we see that this is actually really driving empirically what we observe in the data. So as I already signaled, this is going to be an empirical paper. So let me give you more detail on the data we're going to use and some stylized facts. So there are several sources of data. What's important to remember is that this is Peruvian data. Peru is a representative country in the aspects that are important for this question. So in terms of dollarization of deposits and of the type of monitoring practices put in place. I'm also going to show you some statistics for other Latin American countries to make the point that what we observe for Peru seems to generalize for other countries that also allow these dual currency in their banking sector. Brazil is not a country that allows dollar deposits, or at least is highly regulated dollar deposits. My understanding, and I have questions about this that maybe you guys are more into it than I am, about what's happening in Brazil. I think Brazil is kind of trying to transition. What I'm going to show is that for a lot of the countries that allow these dual currency systems, what I'm going to be showing you from Brazil, in Peru, is actually true. So what happens in Peru is that you can go to the bank and you can deposit your money or in dollars or in soles, which is local currency. And so this is, and you can also get a loan that is either in dollars or in soles. Anyone can do it, right? So it's kind of this dual currency type of banking system. So the most important piece of the data is the fact that we observe interest rates on loans in local currency, which is soles, and foreign currency, which is US dollars. Although there's no restriction, there's no other currency that these loans are issued on, right? So this is an endogenous decision of like, they only want credit to be issued in dollars or in soles. There's no decision to borrow in euros or in Japanese yen. These are the only two currencies that we observe in the data, although regulation-wise, there is no restriction.
But Juliana, sorry, may I ask something? Surely there was some aggregate data available on interest rates, right? On spreads.
There is some aggregate. I think there's some aggregate data. I'm not sure. The central bank, the banking regulator in Peru, has a lot of data, so you can kind of see like average deposit rates and average loan level rates. But it's hard to make any inference about this because you cannot control for firm risk. You cannot control for maturity of the loan. So even though you're going to see some type of average rates, it's hard to tell that the firm that it's borrowing both in. So what I'm going to show you is that for the perfect experiment, which is the firm in the same quarter borrowing in dollars and borrowing in soles, we're going to observe this 2%. So we can control for everything under the sun in this data. So there's no like selection that would explain, right? Because even if you see aggregate data, you cannot make an inference about the dollar discount because you can say, look, the quality of the firm borrowing in dollars is different than the quality of the firm borrowing in soles. And this is why we see this interest rate differential, right? Can either be, firm risk. And actually, no, once you go to the level of detail that we have, that it's actually firm level it's actually loan level. So for us, it's loan level data. and we can control for everything, you're going to see that it's none of those things that are explaining. It's truly, you know, for the same firm in the same quarter, when they borrow in soles and versus they borrow in dollars, there's this 2% differential.
Okay, but surely, like you know, you ask a Peruvian on the street, he would know that, right? I mean, if he ever borrowed before, like it's not a. I mean, why do people borrow in dollars? Because it's cheaper. It's a known fact, right? You're quantifying it to it.
It's so two answers to this. First, our data set is corporate, right? So we're thinking about firms. We're not thinking about personal loans. The second answer to this is that I'm not sure if it's like fully known, and also the size, right? Even though, you know, even Rogoff's job market undergrad thesis talks about these UIP deviations. So yes, we know that UIP deviations exist. What we don't know, so uncovered interest rate parity deviations exist. What we don't know is that they translate in loan level, right? Controlling for everything. So I think that's where we come in. I haven't seen an evidence of the size of the dollar discount, but it's true that, as I was saying in my motivation, anecdotally, we know that borrowing dollars is cheaper. What I'm going to say is like how much cheaper, even controlling for any type of selection or bank specialization or anything that you can kind of think about, we're going to control for, right? And we're going to show you that it's so large. 2% is about 30% of the rates in soles, is 30% cheaper in dollars. It's so large, and that it justifies these dominance in dollar credit, in the credit markets, right? So that's kind of where we're coming in. So like the idea we have is that you can only understand the quantity once you look at prices, right? So the prices are going to explain the quantity, and usually we don't see the prices, right? We don't see loan prices. So the main difference we have in this data set is that we observe interest rates on loans. And this is different than the credit registry data that many studies used, myself included. I have used credit registry data in Hungary, for example. And when in those data sets, you don't observe rates. What you observe is like a balance sheet composition of the firm, right? So you only observe rates once you go through this like banking regulation type of view of the world. And this is exactly what we have. Our data comes from collection of the bank regulators. And because, you know, bank regulators are in Peru, are so worried about dollarization, they collect this data set. It starts in 2012, but they start collecting rates. And we're going to be able to collect, to connect this traditional credit registry data that only looks at balance sheet of the firms with the interest rate data. And we're going to see exactly on a loan level, controlling for everything, how these loans are priced. One last point is that this data is novel and has never been used for academic research before. So let me show you some summary statistics. So here we compare loans in soles and loans in dollars. And overall, the overall characteristics of these loans are very, very similar. You know, it's not driven by the fact that these banks are foreign. It's not driven by the differential maturity on these loans. It's not different by the size of these loans. All these characteristics already looking from, you know, it's already very similar. So in our sample, we have 1.6 million transactions, and 50% of these, in 55% of the commercial loans issued in Peru. We're going to observe all loan types, including credit lines, trade loans, letters of credit, and leasing. We're going to focus on commercial loans as this corresponds to 95% of total loans. All these commercial loans are going to have a fixed rate, regardless of the currency. There's going to be upfront fees, but no maintenance fees. So these loans are identical in nature. So we also do see hedge positions of the firms, but this is very, not many firms in our sample or even in Peru use derivatives, right? And this is common across other countries as well. We know that this is true for Chile. I know that this is true for Hungary. So in our sample in Peru, only 15%, 1/5, of firms with dollar loans have a financial hedge. And the maturities and quantities might not match. So these firms are truly exposed to exchange rate risk. So here's some other statistics. In 2018, about 40% of the corporate credit in Peru was denominated in dollars. And this is a number that is very similar in many emerging markets that allows for dollar loans. So here we look at loans and liability dollarization. Obviously, Brazil, there's some, but it's less. And what we see is that this number is overall similar. Some countries have more, but countries with restriction has less. So in Brazil, from our data, only from financial soundness indicator, only 14% of the loans and liabilities are denominated in dollars, but we also know that Brazil has a lot of restrictions in the deposit rate, in the type of deposits you can have. You have a question, Ivan?
Yeah, Ecuador is, I know, it's a dollarized, fully dollarized country.
Ecuador, is it here?
It's probably 100% or no?
It's I don't know why it's not here. Probably there is no data. So this is like Latin American countries for which there was data in the IMF.
Probably it's 100% because I think they don't have a currency.
It might be that it's 100%, but you know what we see is that a lot of the countries with restrictions you see less. This is coming from Galindo and Linderman in the IBD, in the IABD. So, so here we have in Peru we're going to have about 40% of this credit, and this is consistent with an average of emerging market economies. And what we see is that what we want to tell you, what we want you to get out of these graphs is that this is not firms that are exporters or naturally hedged getting these dollar loans. What we want to say is that these are firms actually taking credit risk. So here we're going to do this by showing you these two graphs. The first one that is green and orange, we sort companies into exporters and non-exporters and look at the share of dollar credit. And here we can quickly see that this is not just exporters trying to match the currency of their revenue with their liability. While exporters do have a slightly higher share of dollar debt, non-exporter firms also borrow heavily in dollars, right? So here, non-exporters, they also have over 40% of their debt being denominated in dollars. But in Peru, we can actually do better than that. And this is the other graph with 3 colors. The regulators in Peru understand that while banks can be perfectly matched in terms of their currency of their balance sheet, corporations might have some balance sheet exposure to their currency risk. Therefore, the regulators make banks qualify their borrowers in terms of their exposure to foreign currency. The Peru banking regulator is the only country to our knowledge that does this. And they make the banks classify their, they look at the composition of the revenue, the financial hedges, everything that the firms kind of report to them. And then they classify the firms into exposed to exchange rate risk, which would mean that these firms default if there is a 20% depreciation of the soles, and very exposed to exchange rate risk, which means they would default if there is a 10% depreciation. And what we see is that across all sectors in the economy, there are firms that are exposed to exchange rate risk. And they're exposed a lot of the times not through their sales or their revenues, they're exposed because of their balance sheet, because they choose to borrow in foreign currency. They choose to borrow in dollars, right? So they're making what it means to be exposed. It means that if the soles loses value, if we have a currency crisis that the soles depreciates, we're going to see that these firms are going to start defaulting, right? And they're going to do that because they have some liabilities, they have some loans that are denominated in dollars. Why are they doing that? Well, I already pointed out, they're doing that because it's cheaper. So this is what this graph is going to kind of summarize the message that I'm going to say in the next couple of slides. So the regression results that I'm going to do in a couple of slides feeds off this graphical observation, right? This is a good summary. And it says there are 3 lines, and all lines in these graphs are differentials. So the top dashed line that we see over here is the difference between the rate charged for credit in dollars minus the rate charged in local currency. And here we already see this evidence of this 2%. So this is an average. In a minute, I'm going to go loan level, but this is just an average. But here we already see this average of 2% that I was talking about, right? So this is the top dashed line that tells you that borrowing in dollars is 2% cheaper. Later, I'm going to do a better job to proving that this survives even after we apply many controls. So this is not driven by a certain type of firm borrowing in dollars and another type of firm borrowing in soles, or any type of maturity differential. And I'm also going to show you that it survives even after we adjust for expected exchange rate movements. The next line is the blue line, and is the difference between deposit rates in dollar and soles in Peruvian banks. And here we can already see the second point of the paper, which is that these two lines track each other pretty closely and seems to feed off each other. What we're going to show is that it's driven by deposit discount, and then this deposit discount has to be pushed out of the banking system because they need to have their balance sheet to match into the loans. So basically what we want you to take away is that it seems like this blue line is generating this differential in the dashed line. And then the last line is the differential between central bank rates in Peru and the US. And this is kind of the suggestion that if you're going to calculate uncovered interest rate parity deviation in the way that we usually think about this, which is through government financing rates or any type of aggregate rates or macro rates, you're not going to explain what we observe in credit markets. Credit markets are not derived by macro, but they're actually derived by micro, by depositors, right? So it's much more close to these two rates than these rates. And then, so basically, I'm going to show you for the next couple of slides, the message that it's summarized in this table in a very, very careful way with many controls, with this fantastic data set to show you that, you know, this survives.
Sorry, Juliana, can I ask? So the data source is SBS, right? Is what you said?
It's the banking regulator. Yes.
Right. Yeah. So actually, we happened to interview a PhD candidate this year who's using the same data set. That's what she's Peruvian, Maria Amado. I'm putting the.
Who is it? Okay.
Just for you to know, she was a PhD candidate at some UCLA, I think. So I'm just putting her job article, but she's just using the same data set.
So our understanding, and it may be, is that, you know, only we had access to this data.
No, but in her paper, she's saying that she's also having access, and she thanks people from the central bank.
Okay. So, yeah. Well, it's fine, but yeah, our understanding.
Yeah, but it's not exactly. She's not exactly doing the same thing, but yeah, I thought.
Yeah, I'm sure. Yeah. No, we've been doing this for a while, so I'm sure it's not. This has circulated a ton. It has been presented in NBR twice, so I'm not that worried. Okay. So what happened here? Okay. So I'm going to start by measuring the dollar discount. So first, we're going to run a regression to measure the raw difference in the dollar and local currency rates. And we're going to find that it's kind of, we're trying to track the results in a loan level of the dashed line in the previous graph, what it was picking up. So the dependent variable here is going to be interest rates for loans denominated in dollars and soles. The dummy identifies a loan, a dollar loan. So the dummy we have here is going to be 1 if the loan is denominated in dollars. And it's going to be picking up the differential in the dollar loans, right? The cheapness of the dollar loans. And here we pull all loans together, but as you can see in the bottom of the table, although it's not fully reported here, but it is in the paper, we have a bunch of firm and loan level characteristics. And we also have a large array of fixed effects, right? So we have industry quarter fixed effects, bank quarter fixed effect, firm level fixed effects. So if you believe in bank specialization, this should answer any concern you have. It's not that has driven our results. The first 3 columns have different combinations of these fixed effects, and the fact that the dollar differential captured by the dummy changes very little should give you confidence on the robustness of our results. The table is not fully reported here, but in the paper you can see all these rates. The last 2 columns separate across exporters and firms that are exposed. So from the 3-color table that I showed you before, firms that are exposed, meaning firms that the bank understands that it's going to default if there's a 10% depreciation or a 20% depreciation of the loan. So here we have this dummy separating these firms. And although there's additional discounts, or it's even cheaper for exporting firms to borrow in dollars, and it's less cheaper, more expensive for exposed firms to borrow in dollars, right? Because they're more risky. it's nowhere close to this 2% discount. It still survives. It's still, for these exposed firms, it is cheaper to borrow in dollars. It looks to us, we're going to test this later on, that the banks are not actually fully pricing in exchange rate risk, because they're just giving 20 basis points more expensive if you are a risky firm. Risky because of exchange rate risk, not risky themselves, which is what matters for our exercise. I'll show you in a couple of slides the dollar differential on firms that are borrowing in dollars and soles at the same time, which is what I was talking to Ivan about, what would be kind of like the perfect lab experiment. But we're going to lose a lot of our sample, and we have some worries that this is some particular type of firm, but this is very traditional in this literature. So we're also going to show you the within firm analysis from Kawaja, inspired by Kawaja and Mian. Of course, you can tell me, Juliana, these two rates do not need to be identical. The 2% differential could just be a reflection of expected appreciation on the local currency. So what I'm saying is that if you expect the soles to depreciate 2%, or the dollar to appreciate 2%, these are both coins, the same statement in principle, you could say, look, it's not actually really cheaper to borrow in dollars, because once the depreciation of the soles happen, you're going to need more money to pay your dollar loan, right? So what we're saying is that it could be that there, in expectation, once you translate these two loans to the same currency, it could be that they are having the same price, right? So we're going to adjust for expected exchange rate movements using survey data. So to account for exchange rate movements, we're going to create this new dependent variable, which is this R adjusted. And if this is a local currency loan, if this is a soles loan, it's just going to stay as it is. If this is a dollar loan, we're going to adjust the rate for the expected appreciation using consensus forecasts. So basically what we're doing is that for the same maturity, we're going to just bring all the rates into soles rate, one that is already denominated in soles, the other one which is synthetic because it's adjusting for this expected appreciation. And then we're going to run the same regression we ran before. And this is exactly what we do here. Again, we're going to focus on this dummy for the dollar loan. And what we see is that this discount is around the same 2% ballpark. So it's indeed the case that even after we account for expected exchange rate movements, borrowing in dollar is significantly cheaper. So as the firm is choosing ex ante whether to borrow in dollars or borrow in soles, it's going to expect borrowing in dollars to be about 2.15% lower, even accounting for expected exchange rate movements. In the last column of this table, we add the standard deviation of the exchange rate, right? So this is what we do here. And so we're trying to add not only the first moment of the exchange rate movement, which is this average future exchange rate, but we're also trying to add a volatility term to this prediction, right? And the way we're going to do that is because, as I was saying in the beginning of the talk, we observe all derivative contracts. So what we do is that we say, what is the volatility on the forward rate that is being locked in Peru? So we do this standard deviation of the future exchange rate for the same maturity as the loan. And what we see is that although this has an impact, that is, the higher is the standard deviation of the exchange rate, the higher is the risk, the higher is the demand for a discount coming in the dollar loan, meaning if the firm is going to take exchange rate risk, it's going to demand an even higher discount if the exchange rate is very volatile, right? But the impact is actually quite small. When the volatility doubles from its average of 0.1 to 0.2, what we see is that the premium only increases about 10%. So we see a small premium for risk, right? We also adjust by observed rates instead of survey forecasts, and we showed that not only firms were expected the dollar to be cheaper, but it was exposed cheaper. So finally, to really drive the point that we're controlling for everything, we're going to do the same, continuing with these adjusted rates, but now we're going to do it for firms that are borrowing in the same quarter in dollars, and in local currency. So this is kind of the within firm analysis. This is the within a firm analysis that is very popular by Kajan and Mian. And what we see is that the results are very similar. We lose a large part of our sample, as only about, I think, 15% of our firms are borrowing in dollars and in soles in the same quarter. But this is common practice as specifically controls for unobserved time-varying borrower heterogeneity. The fact that it's similar to the previous results shows you that our findings are quite robust. We now show you, what we have shown you so far is, yes?
Juliana, may I ask a question?
Yeah. Pode perguntar em português.
As suas firmas, elas variam de status de atividade de exportação ao longo do tempo?
Ao longo do tempo, não necessariamente.
Porque você não está nem incluindo o efeito fixo de firma, né? Em quase todas as...
Firm quarter, aqui tem. Firm quarter fixed effects.
Na anterior, né? Na anterior você só tá...
Na anterior, não. Sim.
Não, mas então
a gente tem só firm fixed effects.
Tá, porque
Sim.
Isso é uma boa fonte de variação também, né?
Sim. Sim, você está pensando se são firmas que
vão
começar a ser exportadoras, e se elas, uma vez se tornam exportadoras, elas vão pegar emprestado em dólar em lower rates.
Exatamente.
Eu acredito, eu nunca olhei essa análise, porque quando a gente bota firm quarter fixed effects, iria controlar para essa tipo de problema e não muda, it doesn't change the coefficient.
Pode voltar para inglês.
Aí você vê a minha incapacidade de falar português.
É normal, qualquer pessoa.
Em forma técnica. O duro é quando eu fui para o Banco Central do México, eles queriam que eu desse a apresentação em espanhol. Eu falei, não, pelo amor de Deus. Yeah, so we don't see that many... I don't know the answer is I don't know. My guess is that not that much, because this is 2012 to 2018. So it's not like we have an incredibly large sample that would have happened. And probably we don't believe that this is driving our results, because once we go within firm analysis that we can control for firm quarter fixed effect that would solve this problem, we don't see the coefficient changing a lot. So, but yeah, it's something we had it in our minds, and this is why we did the within firm analysis that would control for any type of changing heterogeneity, like a borrower heterogeneity changing over time, any type of unobserved one. Okay, so what I've shown you so far is that in Peru, dollar borrowing is significantly cheaper, and we're going to soon relate this to deposits, right? So now that we establish the size of the dollar discount, we're now going to start trying to trace where is this dollar discount coming from. And we're going to claim that this is coming from bank financing through deposits. And we're going to show you some very convincing evidence towards the side. But what I want to show you before is that there's some numbers for other Latin American countries that tells you that this is not only happening in Peru. We study Peru because we have really good data for Peru. But we believe that this is a more broader phenomenon, especially for countries that have this like dual currency type of banking system. So here we hand collect for many countries in Latin America these dollar deposit rates and soles deposit rates. Column 3 is going to show you that the average difference between the foreign currency and local currency deposit rates, where it's always cheaper or for the bank to finance with dollars than with soles, pretty much for all the countries in our sample. And even stays true even after we account for expected depreciation. So these banks in these dual currency type of setups always kind of have a discount in the deposit rates that they're giving to depositors in foreign currency. And this discount is not compensated fully by UIP, by expected exchange rate movements. Furthermore, we compare this to monetary policy rates. So this is what we have on this other side here, where we, instead of using deposit rates, we use monetary policy rates, which is this kind of idea of, macro type of setup. So this is column 5 and 6. And we see that the discount we see in deposit rates is significantly larger in magnitude than the deviations that we observe in monetary policy. So this idea that government financing or macro financing uncovering interest rate parity is much smaller than once we look into micro data, right? So if we're thinking that this is a global phenomenon, meaning like this type of convenience yield coming from global markets, actually no, this is a type of convenience yield coming from depositor side, right? So we actually in for the case of Peru, we can actually test whether the government UIP matching maturities and matching even the country risk actually explains what we see in the loan side. So this is exactly what we do. We see whether the macro UIP deviation is able to explain what we observe in the loan level, meaning is what we're observing in banks giving loans just what would be the same for countries or like macro financing. And what we see is that while the UIP, macro UIP, it is significant, it still leaves a large share unexplained of these discounts. And what we see is that actually, when we look at the government UIP and the UIP in deposit rates, the cheapness of financing in dollars for banks is actually larger than the cheapness for financing in dollars for government bonds, meaning that depositors accept a larger discount. And this is why we see such a large discount in loans, in loan level data, right? So this is kind of already this idea that the deposit rate uncovered interest rate deviation is larger than governments, meaning there's this desire from depositors. And when we think about depositors, I'm going to be more specific, it can be either firms or households. So we see both. It's actually larger. So what we find out is that for all these Latin American countries that have these dual deposits, dual currency type of schemes, we see that banks are financing with dollar much cheaper than governments are financing in dollars. And this, together with banking regulation that I'm going to show you in a minute, is able to explain what we observe in the data. So for the rest of the talk, we're going to try to figure out what drives dollar discounts, and we're going to do that by focusing in banks, right? We're going to look at banks' balance sheet, look at bank regulation, and try to say, these banks are giving these interest rates or these loan level rates that are so cheap, not because overall it's cheap to finance in dollars for anyone, but actually because for them, because of depositors' preferences and inelasticities, together with banking regulation, they have to pass through these deposit discounts through the loans. So now we're going to start looking a lot into...
So, sorry, Juliana. So it seems that regulation is... So, I mean, a question, do these governments are they happy with the situation, or would they like to kind of, have more lending and borrowing in domestic currency? Because it appears that the regulation is driving that. So there, as you said, right?
It's complicated. So it's a connection between... So the regulation is in place because you need to make banks not take risk, right? But actually, I think the source of the problem is even before, is the depositor's preference for dollar savings, right?
So that comes from a history of devaluation and so on.
It comes from a history of high inflation, which has been under control, right? So Peru has had a lot of success with inflation targeting, but still there's this desire to hold your savings in dollars, and it's what we're going to see. And what happens is that regulation is in place because this desire is very old. And in the past, when there was no regulation, banks had these hugely mismatched balance sheets, which end up leading to these twin crises, where the currency devaluates and the banking systems break. So now, what the government does, or what regulation does, is that it makes banks be matched. And what that does is that, together with this pressure from depositors to hold dollar savings, the banks end up passing the risk away from their balance sheet into the corporate balance sheet, right? Mm-hmm. So a lot of the times, I think when people, what I think it's not extremely understood in the literature so far. And a lot of these models that kind of think about this problem, like Bacola's model and even Gita's model, and a lot of the work of majority and co-authors, they don't account for the fact that banks do not carry risk. They don't. And I think this is coming up, like I've been to a lot of meetings lately, and this is coming up pretty, Sadman keeps saying, banks in Turkey don't carry this risk. Banks in Peru don't carry this risk. Banks do not carry this risk. So I think what we need to understand is that, is to understand that banks are just passing through this risk. A lot of the times when I was presenting, I have this work on Hungarian paper that thinks about firms borrowing in foreign currency in Hungary, which is also happens a lot. A lot of the questions I got was like, why aren't banks doing the carry trade themselves? Why are they giving it to firms this cheaper financing, right? And the answer to that question is because they can't. And I'm going to show you why they can't, right? It's regulation, right?
And just so Brazil does not have this issue. I mean, because why? Because people believe more, trust more in domestic, in government bonds, in domestic
currencies. They can't.
So the regulation prevents them from doing that? It's purely...
So this is the conversation. Essa é a conversa que eu estava tendo com o Márcio no passado. É ilegal depositar em dólares. Certo, Márcio? Ele até me deu o número da regulação.
Você pode fazer um arranjo pelo qual você faz uma indexação, mas certamente não é o transeunte que vai entrar no banco e fazer isso.
Exato. No Brasil, você não pode ir para o banco e falar assim, eu quero manter o meu dinheiro em dólares. Você pode carregar dólares embaixo do seu colchão, que era o que a minha mãe fazia na década de 90. Você pode ter uma coisa indexada ao dólar, mas, pelo menos, eu não conheço muita gente sofisticada suficientemente que tem isso, entendeu? Então, isso não gera pressão ao sistema bancário.
Agora, só pegando pelo outro lado, quando nós tivemos episódios de empréstimos em dólar, por exemplo, na época do Gustavo Franco, né, que pessoas podiam pegar e tudo mais, eram muito mais baratos, e essa era a razão pelas quais você pegava. Então, quer dizer, não tinha esse efeito dos depósitos ao qual você está se referindo, pelo menos não dos depósitos dos bancos. É claro que eles captavam. Eles
captavam via money market funds.
E emprestavam, né? Então...
não, tem uma coisa que eu vou falar um pouquinho, essa coisa do core versus non-core financing. Então, essa é uma linguagem um pouco do Shin, do BIS, da Bruno Anchin. E core financing vai ser depósito, e non-core financing vai ser essa coisa do money market funds. E eu olhei um pouco no balance sheet, e o problema do core versus non-core financing é que quando você está dando emprestado em dólares, no caso do Brasil, porque está captando dinheiro externo, esse dinheiro externo é muito mais cíclico. Então, é muito mais arriscado dar dinheiro emprestado para o banco, captando assim, porque esse dinheiro pode dry up muito rapidamente. No caso do depósito, é diferente, porque no caso de uma expectativa de desvalorização, o dinheiro não dry up, o dinheiro, na verdade, aumenta. Então, se o financiamento vem de depósito versus money market funds, o resultado é diferente. No caso do Peru, tem muito pouco money market funds, é tudo muito vindo de depósito, que eu vou mostrar em um minuto. Então, é um pouco diferente da situação que aconteceu no Brasil nessa época, entendeu? Mas eu acho que é super interessante, porque pode acontecer, mas vai vir não de depósito, mas de money market funds.
Juliana, eu acho que no caso do Brasil, quando tinha esses empréstimos em dólar, os bancos captavam em longo prazo, eram empréstimos de 8 anos. Não era money market funds, não.
Então, eu vou mostrar um minuto, cadê? Aqui. Estou saltando. Quando a gente vê para o Brasil, 4% é foreign liabilities dos total assets. Agora, isso vai de 2006 a 2019, então eu não tenho dados prévios a isso. Mas existe muito uma literatura que fala um pouco do Money Market Funds or Global Banks. Essa é Bruno and Chen, o paper da Sebman que está no Restud, vem de Money Market Funds. Então, tem essa ciclicalidade com o VIX. A gente não tem isso porque, para a gente, no Peru, 55% vem de depósito e muito pouco vem de foreign liabilities em termos relativos. Eu vou mostrar isso em um minuto.
Juliana, foi bom você ter projetado essa tabela. Eu te fazer exatamente uma pergunta sobre isso.
Vamos lá.
No caso do Uruguai, você tem também o mesmo padrão?
Sim. Aqui, 62% do bank financing...
Não, eu sei. Não estou dizendo mais, empréstimos em dólar são mais baratos?
Sim. A gente não tem os dados desagregados, mas sim.
Sei. Porque o Uruguai tem uma tradição longa de depósitos
sim, e
em
até
dólar.
Quando a gente vai nessa tabela, você vê que o Uruguai... cadê? Eu tenho uma tabela que mostra o tamanho. Aqui. Uruguai é 63%.
Deixa eu te perguntar Posso perguntar uma coisa? Eu estou tentando imaginar o que você esperaria para tirar essa palavra TIP aí do seu paper. Você esperaria o quê? Que as taxas fossem todas iguais em dólar e sols, que a taxa em dólar no Brasil fosse igual à taxa em reais? É isso que você acha?
Uma vez ajustado pela
sua economia?
Sim, no sentido que se você tiver... isso é o que diz a parity condition, né? O desvio da parity condition. Ou seja, você esperaria que uma vez que você ajustasse para expected depreciation of the exchange rate, as taxas fossem iguais.
Eu não acho, não, porque você tá esquecendo as condições de arbitragem, né? Então, essa uncovered pair
não é arbitragem.
Não captura os riscos associados à mudança de preços relativos. Tem mudança de preços relativos entre Brasil e Estados Unidos, entre Peru e Estados Unidos.
Você está pensando em preços relativos e inflação?
Não, mudança de preço relativo mesmo. Tem um boom de commodity, vai mudar os preços relativos dos dois países.
Isso
o Brasil quebra, porque tem uma queda de produtividade, vai mudar os preços relativos.
Mas isso não estaria captado no expected exchange rate movement?
Um expected exchange movement.
Então, mas
isso daí causa uma diferença de dinâmica de preços, de payoffs, e eu não vejo.
Mas o que a gente mostra é que mesmo a gente usa survey data para account for that, e a gente mostra que mesmo accounting for expected exchange rate movements, você ainda assim tem esse diferencial, ou seja, a paridade não hold, even accounting for expected exchange rate movements. Se fosse tudo expectativa de depreciação do câmbio ou expectativa de inflação diferencial, uma vez que você ajustasse para expected exchange rate movements, essa dummy devia ser 0. Ou insignificativa. E não é.
Mas, Juliana, insistindo nessa linha do Walter, o seu paper não é um paper sobre violações da UIP, certo?
É um diferente tipo de violação da UIP. É violação da UIP no nível de loan. Em geral, a gente pensa em violação da Uncovered Trade Parity no nível agregado, certo?
Uhum.
O que a gente mostra é que existe uma violação disso a nível micro, a nível de loan. Ou seja, não é só um nível agregado, não é só quando a gente pega exchange rate, government financing rates, mas quando você vai para firm financing, você tem um deviation of the UIP. Que, na verdade, é o que mais importa, né? Porque essas são as firmas que estão pegando emprestado em dólar. Para as firmas, não importa qual é o macro UIP ou o government financing UIP. O que importa é o firm financing UIP. Então, é isso que a gente está mostrando. Que, na verdade, o firm financing UIP é wider and has these roots in deposits that it's different than what we usually have our mindset built when we're thinking about uncovered trade parity. Se você vai em todos os papers de uncovered trade parity, eles vão pegar LIBOR OIS, ou vão pegar algum tipo de macro financing rates. O que a gente mostra é que para loan level financing rates é bem wide, ou seja, é um micro transmission of the UIP. micro to the firm.
Uhum.
O que é diferencial.
Deixa eu ver se eu posso resumir o resultado. Quer dizer, você tem um risco sistêmico, como ele é percebido pelos peruanos, então eles estão dispostos a receber menos nos depósitos em dólar, e a regulação bancária faz com que isso seja repassado para os empréstimos.
Exato.
Okay.
E, na verdade, isso não é um resultado, ou uma coisa que, em geral, é o que a gente pensa quando a gente pensa em Uncovered Trade Parity, ou pensa em different... A gente geralmente pensa na forma da violação em taxas macro, né? A gente pensa em macrofinancing, e not firm level financing. Na verdade, a gente pensa até em dívida e não em loan, empréstimo e não em dívida, né? Desculpa. Em geral, pensa em bonds and not loans. What we're showing is like loan level evidence of uncovering trade parity deviations that has its roots not on global players, but on the local depositors.
Okay. Juliana, aqui é o Sérgio falando, tudo bem?
Eu achava que era você, mas saber, desculpe.
Não, tudo ótimo. Então, eu estou vendo, muito bom ver você, o paper realmente excelente. Vendo a visão do Banco Central aqui, eu bati o olho e falei, isso é depósito. E será que esse negócio seu aí não é porque você não está desbalanceado como regulador, controla o risco de crédito dos bancos com o risco cambial? Então, o que acontece? Se o banco ficar exposto aos depósitos e investir mais em pesos, ele vai ter um risco cambial lá que o Banco Central deve cobrar bastante capital dele.
Exato. Eu vou te mostrar em um minuto isso. Olha só, Sérgio vem do Banco Central e o meu coautor, Brian, é o Bank Regulator. Então, é exatamente isso. Mas, na verdade, isso não é uma coisa que, obviamente, para você como practitioner, é óbvio, mas não é óbvio in the literature.
Academia, né? Sei. Não, ótimo,
então,
beleza.
É exatamente isso que você está pensando, está acontecendo. Mas deixa eu te mostrar. Finge que você está surpreso. Mas sim, você está correto. Me dá só um minuto. Mas é isso mesmo. Ok. And by the way, e assim, eu sei que parece óbvio, uma vez eu vou mostrar essas coisas, e até o Sérgio, para ele, é óbvio, que para mim eu vejo como uma coisa excelente, porque faz sentido, né? A gente não quer mostrar uma coisa que não faz sentido, mas, na verdade, esse resultado não existe. Ninguém mostrou, não é uma coisa que se pensa, né? Existe muito essa perspectiva que isso é macro, que os bancos não têm nada com isso. E não é verdade. So, let me go back and kind of like start looking at the bank's balance sheet. And that's what I'm going to do. Okay. So we're going to go back and try to figure out what drives the dollar discount. So we're looking at bank's balance sheet. And como Sérgio already said, this is regulation. And together with regulation is this inelasticity or this desire from depositors to borrow, to save in dollars. And so far the literature has really focused not on that, but on like global investors, right? And this is like households and firms trying to save their money in dollars. And why I think this is important even for Brazil is because, the regulation is changing a bit. And what we want to say is that if you change the regulation, allowing for banks to have these dual currency setups, and you don't regulate banks to price this risk in, you're going to be in trouble. So this is the result that I'm going to show you next, that it's kind of like this policy looking forward. Okay, so as Sergio already kind of pointed out, banks do not carry Forex exposure in their balance sheet because there's capital requirements attached to it. But in Peru, the tracking of assets and liabilities in dollars is going to be incredibly tight for both local and foreign banks. So this is exactly it. We separate between local and foreign banks because of this huge literature from, capital markets that kind of say that this is foreign banks capturing money from money market funds. It's not in the case of Peru. All banks and foreign banks have this incredible match between their assets and liabilities in dollars. And the reason for that, as Sergio pointed out, is basically regulation, that it's rather typical, and it's true for all banks and all countries, that makes it very expensive. You can even say prohibitive for the banks to carry this mismatched balance sheet. So here is an example that for Peru, if you're exposed $50 in loans, meaning you have $50 more loans than deposits, you're going to have to carry $100 in equity, twice the exposure. On the other hand, if you have actually more deposits than loans, so basically you have more liabilities in dollars than you have assets, you're going to have to carry 10 times the exposure. So it's quite prohibitive in terms of cost to post capital to actually hold a mismatched balance sheet. And this is why we see, as I showed in the previous picture, this quite close tracking between dollars and assets and liabilities from the perspective of the banks. And this is already starting building this narrative that ties together the fact that the discount we're observing in deposits will pop out on the loan side. In absence of regulation, you could think, and that's what people would always tell me when I was kind of looking at things from the firm's perspective in my previous work, that why not banks just keep this cheaper financing? If it's cheaper for banks to finance in dollars than it is in soles, it's cheaper for them to finance in foreign currency than it is in local currency in terms of deposits, they could just do the carry trade themselves and profit from it. But what this tells you is that there's this regulation that is put in place to prevent banks from taking Forex risk that makes them be obligated to pass through this cheaper financing from deposits to loans. And what this makes is that although the banks themselves are not carrying Forex risk, they're going to carry Forex risk indirectly because they're going to lend to firms that are risky. And what I'm going to show you is that they're not going to price that in. So if there is any type of currency crisis, you're going to have the bad firms borrowing, and that can generate the banks indirectly holding risk. But directly, they're not holding risk, meaning they're not having a mismatched balance sheet between loans and deposits because they can't, as Sergio was pointing out. The last piece that I need to show to tell you that this narrative makes sense is to show that depositors are a primary source of funding. And this is exactly what we show right here. So deposits are 70% of dollar funding. This is about this dark blue line here. 70% of dollar funding is coming from deposits, both in the domestic banks and foreign banks. You can ask me, Juliana, what are the other types of liabilities that the banks could have? And it's this idea of these money market funds giving money, which would make, and as we see in the data, that it's much more volatile type of funding. What we show is that for deposits is not as volatile type of funding. And importantly, it doesn't usually get out of the banking system once there's a crisis. So what we see is that, deposits is a large type of financing for many emerging market economies. It's not only for Peru. So this is the graph I was showing you before. And also for Peru, we can do better than that. We can do it at bank level. And we see that overall, in most of the banks, about 73% of the financing is coming from deposits of the dollar financing. There's very little foreign liabilities, and there's very little diversity, right? When we look at the percentiles, it's pretty, it's not coming from any type of heterogeneity on the banking system. And we also see that the deposit composition, that this is not only being driven by households, but it's also a lot of this is being driven by firms, right? So we can't separate the story of Luigi Boccola with Lorenzoni, which tells you that this is just fear of, risk of households, from the story of Gita Gopinhard with Jeremy Stein that tells you that this is just exporting behavior or invoicing. It could be both because we see this coming from households and from firms. So far we show that there is this large discount in dollar credit. We are saying that this seems to be tied to the cost of deposits. We showed that due to regulation, banks do not carry Forex exposure in their balance sheet. So it looks like the key to understand dollar credit is to actually understand this dollar deposit behavior. So this is what I was kind of pointing out to Ivan, that, a lot of the times people kind of look at the output. They look at the share of dollar debt or dollar loans that we observe in the firm and the corporate side. And then we go one step further and we say, look at the banks. And then when we look at the banks, because banks need to be matched, we realize we need to look at this one step further, that we need to understand the demand for dollar deposits. So to provide additional evidence of this channel, we're going to look at changes on the reserve requirements of dollar deposits. So an increase in the reserve requirements is going to decrease how much deposits one can lend. So it's kind of affects the cost of financing from the banks that are holding these deposits. Reserve requirements in dollars and local currency are going to be treated differently in this banking system. We're going to use for our first test this differential changes in the marginal reserve requirements to identify shocks to the effective cost of dollar funding. The basic idea is that we're trying to understand the elasticity of dollar savings. During the period we studied, there are a few big changes that we're going to focus on. What we're going to show you here is that this is the change in the differential. So if both the reserve requirement in dollars and soles go up by the same amount, the differential is 0. If the reserve requirement in dollars goes up by more than the reserve requirement in soles, this is going to be this positive change we see. And we're going to look around 2 periods that are highlighted in red and dated. The top ones are 2014 and 2015. There's these massive asymmetric increases in the dollar deposit reserve requirement. So basically the reserve requirement in dollars goes from 50 to 70%. And nothing really happens in the soles reserve requirement. So this is a huge shock for the cost of the banks to hold these dollar deposits, right? Because they cannot really lend everything. And then these are going to be wind off at once. In one stroke, it goes down 20%. Into December 2016, one can ask if there's something weird going on in the exchange rate. The answer is not. What we're going to see is that what happens to deposit rates over time. And a rise in reserve requirement can be absorbed by depositors and or by borrowers. At the limit, if the demand for dollar savings is inelastic, the adjustment is going to show up as a contraction in rates, a lower deposit rates in dollars without any movement in quantity. We're gonna in the next slide, we're gonna test the rates and quantities in response to these changes. Here's just a visual of these results. We're gonna aggregate 2014 and 2015 together because these are tracking each other. These are 2 sequential increases of 10. And this is this line that moves up in the reserve requirement. What happens to the dollar deposit rates if you shoot up reserve requirements on the dollar deposits and not on local currency? What we are going to argue in this paper is that there's reasonable exogeneity about the quantity of the shift as these changes were unprecedented. For the whole time, there was never this huge change of 20% in reserve requirements, either up or down. And what I'm going to show you in the next slide can be tracked really easily in this picture, which is because we see that deposits are inelastic, the pressure is going to be absorbed through the deposit side with a drop in deposit rates without any movement in quantities. Now let's use regression to analyze these episodes. So to construct a benchmark for the interest rates, we assume that the compensation for reserves is 0. That's something made by...
Yes. Juliana, eu acho que eu fiquei meio perdido aqui.
Fala.
O que você está supondo? Que o depósito é inelástico? O que isso quer dizer?
Significa o seguinte, que quando o banco está tentando tirar a pressão que ele tem no depósito em dólar para ter que dar menos empréstimo em dólar, ele não tem a habilidade de diminuir o rate, porque existe uma inelasticidade quanto à demanda de depósito em dólar. Uma forma de eliminar essa pressão que o banco tem seria ter menos depósito em dólar, mas não existe essa habilidade, porque existe essa inelasticidade. Então, porque tem essa demanda...
Isso é uma hipótese? Espera aí, eu quero só entender. É uma conjectura que você está testando, é isso?
Eu vou testar. A gente usa a mudança no Marginal Reserve Requirements para testar se depósitos são inelásticos. Por quê? Porque any change in the Marginal Reserve Requirement is going to decrease, is going to increase the cost of the bank to hold these deposits. If you have that depositors are inelastic, the bank can pass through this entire cost to the depositor. And what we see is actually this happens without any movement in quantities. So we're going to think about like taxation, right? If you increase taxes, it can be either held by the demand or the offer. If the demand is inelastic, the person, the offer, the firm is gonna completely pass this through to the demand. And this is exactly what we see. So we're using these shocks in the marginal reserve requirement in dollars to test the assumption that there's this inelasticity. Because this inelasticity can, on the depositor side, can explain why the banks having to match this balance sheet mismatch, they end up passing the entire discount to loans. Respondi sua pergunta?
Eu ainda vai em frente, talvez eu entenda melhor mais adiante. Deixa eu tentar, então, pôr a minha dúvida básica. Eu ainda estou tentando me entender. Eu entendi que você está dizendo assim, olha, o driving force do seu modelo é o que está acontecendo nos depósitos em dólar. Tá? Esse é o que você está dizendo. Você tem uma economia que alguma coisa esquisita está acontecendo nos depositantes, eles estão aceitando receber menos do que deveriam receber para ter depósitos em dólar. Tá? Quando coloca uma hipótese assim, mesmo que eu tire regulação totalmente do jogo, eu poderia pensar algo, olha, isso você tem... Vamos pensar num modelo de utilidade aditiva bem tradicional, o consumo está variando no tempo, quando a economia no Peru estiver muito mal, o consumo está lá embaixo, e o dólar vai disparar porque vai ficar mais difícil de importar. Então, nesse sentido, você deveria haver um prêmio aí, o depósito em dólar funciona como um hedge para essa volatilidade negativa de consumo. E aí você deveria, é natural, esperar que tenha um retorno esperado menor em dólar do que em sols.
Isso agora, é uma das razões...
Então, isso, para mim, por isso que eu digo, é normal, eu esperaria normal ver alguma coisa diferente entre o dólar, a taxa de juros em dólar e a taxa de juros em sols. Agora, o que o seu modelo pode dar de diferente, aí é que eu não estou conseguindo ver as fricções direito, a capacidade minha, é o quê? Você tem uma variação nesse prêmio de risco. Essas probabilidades de risco não são as mesmas em todos os tempos no Peru, muda com o tempo. Aí você deve ver esse desconto mudando com o tempo, e aí tem um pass-through aí para os empréstimos.
A gente tenta pegar um pouco...
Eu acho que é o que você está analisando. Agora,
não é 100% do prêmio de risco, porque se fosse só prêmio de risco, uma vez que a gente colocasse a volatilidade do foreign currency risk, deveria, e isso não é nem a volatilidade perceived by deveria comer tudo, e não come. Ou seja, quando eu fiz a análise que era the regression with the dummy variable for dollar loans, with the volatility of the forex rate, although it was there, it didn't completely eliminate the premium.
Juliana, mas é difícil a gente estimar prêmio de risco, né? Quando o prêmio de risco é volátil. Então, você esperar que a sua regressão capture tudo, eu ia ficar, puxa, que coisa maravilhosa, você está...
Mas existe the UIP violation, one of the reasons of UIP violation, or one of the explanations for UIP violations, which is what we're observing both in the deposit side and in the loan side, is the peso problem, right? Which is the huge depreciation. And that's fine. And if that's it, that's it. But still, like, it's surprising to see this originating in the depositor side. And maybe it's originating, we don't know why the depositors are being so inelastic. And it could be coming from this, peso problem, maybe. But still, it doesn't come away from the fact that it's important to understand that the origin of dollarization of the corporate side is coming through depositors and depositors' preference. And that's what we want to show. Why depositors have this preference, you're saying, is risk premium. Gopinhard and Stein claim that it's invoicing. Bocal and Lorenzoni claim that it's risk premium. We still don't know, right? It's just that it exists. I don't think there's a consensus on why it exists. And what we're showing is that empirically it's there, and it's originating from the deposit side. And this is what we think is our contribution to the literature. I don't think it's surprising. We all know that there is this discount. What we want to show is that this discount is large. This discount is larger than what people imagine when they look at aggregate data. And this discount is coming from the fact that from the perspective of the depositors, there is this preference or inelasticity on the deposit rates, right? Which is exactly what we show here. So we have a benchmark that tells you that if deposits are inelastic, once we see this going from 50 to 70%, we should see that it drops, the deposit rate drops by 0.287. And we do estimate something, we fail to reject that hypothesis. And also we should see that the share in dollars does not change, and we also fail to reject that hypothesis. Similarly, when it goes from 70 to 48, this stroke down, we also fail to reject the hypothesis, the benchmark that would imply an inelastic demand for dollar deposits. So what we see here is that there's evidence on deposits being inelastic, leading to a cheaper dollar financing for banks, and these banks to comply with regulation, and is what is ending up pushing this dollar credit into borrowers. And this potentially exposes them to risk. So next, I'm going to show you quickly, I think I have 1 more minute, is that correct? Yeah. Okay. I'm going to show you that it's going to lead to borrowers taking risk because banks are actually not pricing it. So this is what we show. We show that, borrowers are more likely to take this risk. The probability of obtaining a dollar loan as credit changes, which we do as days of past due loans, increases. So as borrowers deteriorate and their credit rating gets worse, they're more likely to take a dollar loan. And this is consistent with the fact that the need to match the balance sheet makes banks not price in exchange exposure and makes selection of these bad or not risk tolerant firms taking this risk and exposing indirectly the bank's balance sheet. To drive this point home, I'm going to use these changes to the capital requirements to show that beyond banks not pricing this risk in their loans, they're not provisioning for this risk. So here we have episodes where the capital requirement for exposed loans shifts up. This is identified by this dummy post. These increments are very small. It's only 0.8%. So the capital requirements goes from 10 to 10.8 for loans that are exposed to risk. And then it changes very little the pricing of these dollar loans. And this is going to be consistent with the fact that banks are somewhat playing this role of not accounting for this risk internally. And this is where there's a problem with foreign currency borrowing. Because what you're doing is that you're shifting these loans to the corporate sector, to the firms that are not able to tolerate this risk. And you're indirectly exposing them to this risk because you're not pricing this correctly. Finally, we do not find evidence for bailout expectations. So there's this common literature by Schneider and Turnell saying that banks give these loans because they expect to bail out. We don't find this. We restrict our sample to the larger banks and we don't see any difference. We do find evidence that older firms with more bank relationships do get a better discount. So there's something to do with the competition channel. So I'm 2 minutes late, but I'm going to sum up. What we show is that we analyze this important question of why dollar credit is so prevalent. What we come in is that we are able to observe prices. So we're going to explain the quantity through prices. We're going to say it's so prevalent because it's much cheaper. And it's really a lot cheaper. This is like this 2% discount is very large. And it's coming from deposits. So it's coming from a micro desire to hold these deposits and from the banking system and not from government rates. And what we see, the important question is what drives these deposits and the discount. So to understand corporate dollarization, we need to understand actual deposit behavior. And we have suggested evidence that explains that this is coming from this preference for dollar savings, which together with bank regulation leads to this enhanced carry trade motif. Okay, I'm 2 minutes late, but I made it.
Thank you very much, Juliana.
Thank you.
Muito bom, parabéns.
Juliana, uma pergunta difícil.
Ok.
O que você acha que vai acontecer agora?
No Peru? Ou no mundo?
Não, com os depósitos em dólar.
Eu acho que vai aumentar. Eu acho que você vai ter mais depósitos em dólar, que vai gerar
Mas não
mais...
haverá uma tentativa do governo de proibir, ou de cercear, ou de...
Eu acho que eu tenho que conversar com o Brian agora para saber o que está acontecendo com o risco político. Porque eu acho que o risco político que está acontecendo no Peru faz com que as pessoas queiram ter mais ativos em dólar. Né? Então, isso vai gerar com que os bancos vão ter que emprestar ainda mais em dólar, o que vai ter uma seleção para bad type of firms. Né? Então, essa é a minha preocupação. Eu acho que esse ciclo que gera uma quebradeira das firmas gera principalmente por causa disso acontecendo. No caso, quando a gente pensa que, no caso do Brasil, por exemplo, quando você dá empréstimo em dólar, isso coming from, foreign liabilities of the banking sector, esses foreign liabilities têm o inverso da volatilidade dos depósitos. No momento de incerteza, essas foreign liabilities goes away, o que gera menos pressão no sistema bancário para dar empréstimos em dólares em bad times. Então, eu acho que o problema de vir dos depósitos é mais grave, talvez, num momento de incerteza, do que vindo do VIX, vindo do Money Market Funds. Não sei, o Sérgio é o expert, e o Carlos está por aqui também, estava por aqui.
Mas não haverá, de parte dos depositantes, um temor de mudanças de regra?
Talvez, né? Algum tipo de situação do Collor.
Não precisa ter esse formato do Collor, mas algum tipo de exposição que na conjuntura política agora pode parecer excessivamente arriscada?
Talvez. Eu não tenho uma resposta, porque eu não sei.
Não, por isso que eu falei. Por isso que eu falei que era
difícil, a pergunta é difícil.
Eu não esperava que você tivesse.
Eu não sei, na verdade, até é interessante. Eu vou conversar um pouco com o Brian. Brian é fantástico, ele vai vir ser meu aluno, ele vai ser aluno de doutorado. E ele saca pra caramba de Banking Regulation, então é bem legal. Eu saco pouco de Banking Regulation, mas estou aprendendo. E a Vitória saca pra caramba, então eu faço assim o meio termo porque eu entendo um pouco da parte das firmas, né? O que as firmas estão pensando. Então, isso é como... É o que eu estava falando um pouco com o Werneck no meeting. Eu tenho feito esse trabalho com essa parte de dolarização do sistema corporativo. Inicialmente, a gente pensava... Eu tenho um paper que pensa na Hungria, então pensa no lado da firma. Esse paper é bem legal porque pensa pelo lado bancário. E, não tem... Eu entendo que o Sérgio... fico super feliz que o Sérgio ache isso óbvio. Eu imaginei, né? Porque não é entendimento. Você vai no meeting do NBR europeu e as pessoas apresentam artigo, Matteo Maggiore apresenta artigo, achando que o banco está pegando risco. E o banco não pega risco. Né? Então, a gente tem que pensar que isso não vem de uma conjuntura de risco país somente. Não é um global investor, isso vem do depositor. E mais do que isso, a minha preocupação também na questão do Brasil é que eu acho que está tendo uma mudança de regulação, que eu não entendo bem, que vai começar a permitir depósitos em dólar. E se você não tiver uma fiscalização correta do sistema bancário, fazendo com que o banco não dê empréstimos e não precifique empréstimos, e talvez isso vá acontecer se tiver uma alta demanda para depósitos em dólar, o banco em algum momento tem que flush this out of his system into the corporate sector, isso vai gerar uma quebradeira futura. Então, tem que tomar muito cuidado quando você libera o depósito em dólar, tem que ter um cuidado de também ter um banking regulation bem forte.
Juliana, essa pergunta do Werneck eu acho que é formidável e que eu acho que pode ser um direcionamento bem legal para o seu artigo, né?
A gente não tem dados post-2018.
O que ele falou aí... Não, eu acho que só em termos de discussão. O que ele falou aí, eu acho que o mais próximo, você pode aproximar de duas coisas. Uma é o Corralito, na Argentina, que eles foram lá e falaram, olha, o que está dolarizado não. Aí os caras foram lá e tiraram os recursos, né? E você tem o outro também do paper lá do Pagimian, que foi justamente naquela crise lá, na realidade eles congelaram. E isso gerou o problema também da fuga de depósito. Eu acho que quando eu vi a apresentação do seu paper, eu pensei, poxa, o que é esse equilíbrio está trazendo aí? Olha, os caras estão colocando dólar e os bancos estão passando esses dólares, via depósito, estão passando esses dólares para as firmas. Isso, de alguma forma, limita a ação do governo. Se o governo, por exemplo, quiser inflacionar e desvalorizar o câmbio, o que acontece? Ele vai acabar prejudicando as firmas, vai gerar uma quebradeira nas firmas e uma quebradeira no sistema bancário. Então, antecipando isso, o governo central vai ficar mais controlado. E por isso, como ele está mais...
Esse é o paper do cara lá que ele estava em Harvard. Ai, meu Deus, eu acabei de receber ele de volta. Tem um paper, te mando.
Não, então essa é a questão. Você fala assim, olha, você tem esse efeito, e ele acaba segurando esse efeito. Então, assim, não pode ser uma coisa muito boa, porque talvez ela acaba limitando um pouco esse risco, que é o risco de crédito. O que é o risco de crédito? É de você ter uma mudança súbita na taxa de câmbio. E essa mudança súbita, às vezes, é muito porque o governo quer que desvalorize por alguma razão, e ele vai lá e força ou segue as políticas. Então, eu acho que tem um debate aí que talvez você possa comunicar melhor na literatura. Fala assim, olha, acontece isso, abriu o depósito, colocou o depósito, transferiu esse risco, mas o que isso acontece em termos de macroeconomia também? Talvez pode ser alguma coisa nesse sentido.
Eu acho que só esse pointing out que vem do depósito, junto com o sistema bancário ser regulado, não é um ponto que existe. É um ponto óbvio, mas não é um ponto que existe. Não existe. Eu conheço a literatura muito, não existe. Pelo menos a literatura atual, né? Então, é um pouco o que a gente vem trazendo, é mostrar que não tem esse mismatch e que vem do depositários. Depositantes. Depositantes em espanhol. Ai, senhor.
Mas o meu ponto é o seguinte, isso aí aumenta, quando você vai fazer essa discussão, você vai falar assim, isso vai aumentar ou vai diminuir o risco do sistema? Quando você preferia não ter o depósito ou você prefere ter o depósito?
Isso aí, para você fazer isso, você vai ter que ter um modelo estrutural para analisar o welfare. E não é o objetivo que a gente tem aqui, né? Porque você pode pensar que isso resguarda o value do household e do firm e, ao mesmo tempo, bota outras firmas em risco. E eu acho que a resposta, que é melhor ter ou não ter o depósito, vai depender de como o banco seleciona as firmas para emprestar. Se o banco empresta bem, é bom ter o depósito. Se o banco empresta mal, não. Mas o banco bem ou mal vai depender da pressão que os depositantes estão botando. Então,
Juliana, a sua afirmação de que os bancos nunca fazem mismatch ou não fazem period, eu acho que também depende da época. Eu me lembro que quando eu trabalhava em banco, quando teve aquela primeira crise de câmbio aqui no Brasil, acho que foi 82, já nem me lembro mais. Os bancos ficavam cheios de dólar
por isso que
num determinado período sem conseguir repassar para os emprestadores.
Mas
aí o Banco Central veio, criou a resolução 432, aí os bancos jogaram o risco todos para cima do Banco Central. O Banco Central fez essa besteira. Eu acho que foi uma besteira a título da estabilidade para o sistema. Então, o Banco Central dava presente para tentar suavizar, tirar o risco dos bancos. Então, isso é endógeno. Então, falar que o banco não faz mismatch, às vezes faz.
Regulação. Mas não faz porque tem regulação. Isso é uma coisa agora, não é? Eu não estou falando que que isso
eu não sei como é que é a regulação lá no Peru, tá? Talvez seja
eu te mostrei.
Overregulation. Tá?
Completamente regulado, por isso que tem esse conflito.
Se deixar o banco livre, ele vai tomar algum risco.
Óbvio, mas por isso que não permite. Mas isso não é só no Peru. Você tem um paper do Martin Tobal, que é do Mexico Banking Regulator, e ele mostra que isso é across many central banks.
Eu acho que isso depende da época. No Brasil tinha risco.
Óbvio, claro que depende da época.
No México também teve banco, teve risco durante tempo. Claro. Então, a afirmação de que banco não carrega risco, eu acho que é factualmente incorreto.
Não. Atualmente não carrega risco.
Atualmente pode não carregar, mas As pessoas que trabalham no banco, elas são remuneradas para pensar em coisas inovadoras que vai lidar com o risco.
Sim, claro, mas assim, o que a gente vê agora no Banking Regulator, current Banking Regulation, is that there's no risk. Não sei como é que é no banco. Eu não tenho dados do Brasil, nunca olhei, porque o Banco Central não libera os dados. Mas eu tenho dados do ECB, do Peruvian Central Bank e Chile. E nesses países não tem mismatch. Brasil eu não sei, porque eu não tenho dados. Eu queria muito que
Estados Unidos tem mismatch. Várias vezes Estados Unidos tem mismatch. Bancos quebraram nos Estados Unidos.
Mas atualmente eu não sei, porque isso é regulação recente. Eu não tenho dados.
Bom, é recente, é isso que eu estou falando. Você pode ter épocas que
mas eu estou falando isso é 2012.
Fica mais estável. Mas eu acho que a afirmação de que é tudo depósito, eu acho que a alocação de risco aí estaria meio esquisita.
Eu só posso fazer esse claim during my sample period. Eu não posso overclaim, não tenho objetivo de overclaim. Meus dados vêm de 2012, e a partir desse momento que a gente tem esses dados, não existe mismatch.
Lá no Peru, né?
No Peru.
Tá.
Walter, o que eu diria hoje é o seguinte: em determinados momentos, o banco ele vai pegar o excesso de capital dele ali e vai tomar o risco. Mas ele tem que ter capital para arriscar. Então, você vai pensar assim, em equilíbrio, no longo prazo, assim, ele não vai tomar esse risco total, não vai consumir todo o capital dele para fazer um tipo de posição. Mas, assim, a hora que ele chega e vê, assim, num determinado cenário, ó, ele vai fazer uma aposta, ele pega o capital dele e põe lá. E, assim,
ele perdeu o capital dele,
hoje...
quebrou. Aí ele não vai tomar risco. É isso que você está falando. Agora, enquanto ele tiver um capital, ele vai fazer avaliação de risco dentro dos parâmetros do regulador, né?
Claro.
Agora, se o regulador é tão rigoroso que impede que o banco carregue qualquer tipo de risco, aí é outra história. Aí a história é de regulação. Mas eu não acho que tenha nada assim em decisões de agentes que diga que o banco, como intermediário financeiro, não vai querer fazer algum tipo de mismatch por um intervalo de tempo. É só isso. E eu acho que isso é importante para o teu paper. Eu estou discutindo, porque eu acho que é importante. Porque você tem uma hipótese ali, dizendo assim, olha, é tudo em cima do depósito quitando esse fiscal que está sendo repassado, o pass-through é para as empresas. Tá? É esse o claim que você tem, que eu acho que é um claim interessante e que seria bom você explicar um pouquinho mais a economia que está por detrás desse claim.
A gente explica no paper um pouco mais, e assim, a gente tem muita preocupação com a regulação, principalmente porque os dados que a gente tem são dos reguladores. Então, a gente teve um cuidado muito grande de entender a regulação bancária.
Pode ser que seja o regulador seja excessivamente conservador no Peru.
Não é só no Peru. Isso talvez no Brasil eu não posso fazer esse claim, porque o Brasil não tem. Mas é uma coisa que existe em muitos países emergentes que permitem isso. Na Turquia é assim. No ECB, assim, não é uma coisa que é particular do Peru. É o Basel II, eu acho.
3.
Eu não sou reguladora bancária, mas eu estou...
Bom, muito obrigado, Juliana, foi ótimo.
Prazer.
Muito obrigado, Juliana, muito bom.
Muito feliz de ver tantas caras... familiar faces. Gente, meu português está o bicho, e depois de pós-parto, sem capacidade mental. Mas muito obrigada. Um prazer.
Valeu, Juliana. Um beijo.
Tchau.
Tchau, Juliana. Prazer te ver aí.
Prazer. Sérgio, vamos coautorar um paper, cara. Me libera dados.
Aí vamos, eu vou conversar assim.
Me libera dados. Eu preciso de alguém sendo do Banco Central. Vocês não liberam dado nenhum, cara. É um absurdo eu ser convidada para fazer um paper com dados do Banco Central Europeu e não do brasileiro. É vergonhoso.
Isso é vergonhoso mesmo.
Agora, o duro é que não liberam para Laura Alfaro, então não vão liberar para mim jamais. Porque se não liberar para a mulher do Kankizu, que não vai liberar para mim, entendeu? Pô, Werneck, ninguém libera dado no Brasil, é desesperador. Bom, se tu tiver dado e quiser fazer paper, me fala que eu faço paper.
Beleza.
Beleza.
Valeu,
Beijo,
um abraço,
gente.
beijo.